everyone. My name is Lee Johnson. I am the co-founder for Value Investment Partners. Value Investment Partners is a private real estate investment organization here in Northern Virginia. So if you're ever in the area, drop by. Let's have a coffee. So today we're going to continue our conversation about multifamily syndication. Last month we put part one up. If you weren't able to catch with part number one, that's going to be on our YouTube channel. I guess it's going to say something about multifamily apartment syndication part one. Today is going to be part two, and we're going to go through the slides, but we'll open it up for a little bit of a discussion as we traverse this presentation at the same time. As I always mention, we have to start out with our little bit of a disclaimer. You know, we live in America and some people are very litigious. I just have to put this disclaimer out there to let everyone know that I am an investor expressing my personal opinion and not a financial advisor. Specifically, I'm not your financial advisor, your attorney, or your accountant. If you're going to invest in any opportunity, I would strongly suggest to you that you consult with your own financial professional before making any financial decisions so that we have an understanding that what we're doing here has a certain level of ethics. We are not, and we do not accept any money from any sponsors or the platform for postings, reviews, referring investors, or affiliate leads or advertising. What this is it's a community for like-minded investors to have a place where they can just chop it up and have a conversation about different forms of investing. Whether you're investing in fix and flips, or if you're a wholesaler, or if you're a hard money lender. Right now, what Value Investment Partners is working on is Value-Add Multifamily Syndication. We were working on our 26th deal. We're currently invested in 25 different syndications, and that's been since 2017. So if you haven't, you can go to our website, valueinvestmentpartners.com, and you can just get a little bit of the history as to what we have been doing. So let's get started now that we're past the disclaimer. The agenda for today is we'll talk about selecting an MSA. An MSA stands for Metropolitan Statistical Area, right? Once you have selected your MSA, you have to do a double click into that MSA. And typically there are going to be, 10 to 15 different submarkets within an MSA. Now, once you have decided on your submarket, we say find a deal, but in order to find a deal, I believe that there are going to be two critical components that you need in order to find a deal. One is going to be a commercial broker, and the second one is going to be a property manager. And that property manager is going to be really critical to you because the property manager will assist you in determining your pro forma as you're putting it together. They know the numbers for that particular area. They know whether or not if you can get the rents that you're going to put into your pro forma. They know about the expenses. They know what's happening in the economic, like with the Office of Economic Development, and they should know what's going on with the Chamber of Commerce. They should have that affiliation inside of that MSA and submarket because they're going to be your eyes and ears on the ground. And the reason why I say that is because when you think about investing in multifamily, you're not limited to your local area, right? I've yet to invest in the DMV product, right? But I have invested in the Baltimore syndication. I'm currently invested in deals in Tennessee, Texas, Houston, Baytown, Galveston, Texas City. I've invested in deals in North Carolina, South Carolina, Florida, Georgia. So there's plenty of places where you can invest. You just have to know what you're getting into. So this is a short presentation for the most part. I'm happy to answer any questions. So, you could either raise your hand or just come off of mute and we'll have that conversation at the same time. So this is the agenda for today. Thank you for joining us. So as I mentioned, you have to select your metropolitan statistical area. For those in the industry, we just call it an MSA. That's a lot of words, but that's what it means, right? Within that MSA, you're going to have particular submarkets. Now, as you are doing your investing, you have to, I would say, you cannot target the entire United States of America. You probably can't either target a particular region, right? But what you want to do is, my suggestion is that you identify 7 potential target markets. As you have probably heard, when it comes to real estate, everything in real estate is about location, 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 right? Some of the things that you're going to be attracted to, depending upon how you're going to operate the asset, is you can start with the city that you live in, right? Online search for top apartment markets. You can use something like U-Haul. U-Haul is a great tool because it tells you where people are moving, right? U-Haul is usually one-way destinations, and it can tell you from those one-way trips where people are moving to. We have seen over the last 3 to 4 years that people are moving to our southern states because our southern states have a cheaper cost of living, right? You could also subscribe to data such as CoStar, the Marcus and Millichap report, which they publish twice a year. There's many different things that you can do in order to get access to the data. What I'm trying to stress to you is that you do not need to pay for this data if you have access to this data from a free resource. So, excuse me, as you are evaluating your MSAs, what are some of the things that you want to be looking for, right? You want to invest in markets where the unemployment rate is trending lower. You don't want to be going to an area where the unemployment rate is accelerating, right? You need people to come into your apartment complex and rent from you. And if the unemployment rate is going up, that means that people probably don't have access to jobs in order to be able to pay your rent. Population should be increasing, right? You don't want to invest in an area where the population is decreasing because there's going to be less demand for your asset, right? You typically want to look at certain ages, and the age is going to be affecting points number 1 and 2, which is unemployment and population. One of the strongest things that I look for is the next 2 items that you see on the list, which is jobs and employers. If you can find areas where um, headquarters are being established, in Texas, Tesla moved its headquarters from California to Austin, Texas. In Austin, Texas, you have Dell Technologies, and you also have a sister complex for Apple. All of that is there, as well as you have NASA that's in the Houston area. You have oil and gas that's inside of the Houston area. All of these things are going to be very critical to you as you are narrowing down your target area, because there are probably over 100, maybe even 200 different MSAs in the United States, right? You want to narrow that down to at most 7 different MSAs, right? And then as you are looking at these different criterias, you want to land on 1 or 2 MSAs based on your ranking, right? One criteria that we added to this list that wasn't there when we initially presented this opportunity was we are now targeting states that are more landlord friendly than tenant friendly. And Texas is a great example of that. You can probably file an eviction on the 11th of the month, and you can have a writ for ownership of the property within 2 to 3 weeks. So by the time you get to maybe the last week of the month, that tenant who's no longer paying your rent is no longer inside of your asset, and you can turn that property and get it back on the market and get people paying at the same time. So that's the criteria that we're using when we're talking about what you're going to be doing from an MSA perspective, right? I hope that that was of value to you. But what you can see here at the same time is that a lot of this information that we have is from the Joe Fairless book, right? Joe Fairless has a book called the Greatest Ever Apartment Syndication Guide. And he also has a website here at the bottom where you can see that information that helped us to get down here. So we're following tried and tested different means in order to be able to get to where we are. So I hope that was of value to you at the same time. Let's move on to the next slide. How to select an MSA. You want to use different reports, as I mentioned to you. Some of these reports are going to be paid reports. But as you are selecting your reports, one of the things that I want you to do is I don't want you to have to pay for any of these reports. The first report that we have here is the Marcus and Millichap Annual U.S. Multifamily Investment Forecast. That's a free report that they publish once a year. It typically comes out around late January or February timeframe. Now, this report is going to be representative of the United States as a whole, but what you're going to be doing, you're looking to try and select 7 MSAs, and then you're going to look to narrow that down to 1 or 2. This report will actually help you to do that. The CBRE biannual cap rate report summary that helps you to understand, well, where are you going to be able to get those good returns that you're looking for your investors. Integra Realty Resources annual viewpoint commercial real estate trends report. That's a great report. One of the reports that I had mentioned to you earlier, but isn't on here right now, is the U-Haul, as well as what's one of the larger moving companies. The larger moving companies, they also publish those reports so that you can see their data as to where people are locating to, right? And as you guys very well know, single family housing in America, we're at like a deficit of 4 million single family homes that are needed. This is a great opportunity for multifamily investors because as a multifamily investors, as these folks are moving into these different areas, if they can't afford a single family house, they have to rent. So I think that it's a truly good opportunity for multifamily owners at the same time. When it comes to CoStar, as you may recall, I mentioned that when it comes to CoStar, you should be developing a relationship with a commercial broker in that MSA. That CoStar broker, that commercial broker, apologies, there is going to be able to furnish you with a multifamily market report. And that multifamily market report is what you can leverage to determine the different submarkets that you want to invest in because they have the criteria that you're looking for. Remember that criteria should be jobs is increasing, unemployment is trending down, there's some type of event going on to a company bringing in, opening up a distribution center like an Amazon distribution center, or a company is moving their headquarters there. As you might recall, Disney, before they got into the fight with the governor, was going to relocate from California. I think it was something like 7,000 to 10,000 employees. That would have been a great opportunity to invest in that area in Florida where they would have been coming. You would have seen that and say, oh, there's going to be tremendous demand for housing there. And at that point in time, we were looking at Florida to determine whether or not if we wanted to invest. But when Disney said that they were going to put that on hold, we also put our research into that area at the same time. So there's a lot of things that are going on, not only from an economic perspective, but also from a political perspective at the same time. Let's move on to the next slide. So as you can see, I'm in the Northern Virginia area, right? In the Northern Virginia area, this is how the DMV is broken down into an MSA, right? So as you can see here, there's probably, I would say there's probably about 20 different submarkets that are here right now where you could actually make different investment opportunities. As you can see, it's a little cluttered over here as to the number of assets that are here. But this is what your MSA is going to look like. If you were looking at the outskirts up there in Northern Maryland, well, in Maryland, you have the Frederick area. Over here, you have the Percival area, Warrenton area, Spotsylvania over here. All of this is here. I'm over here in Loudoun County. So you have different MSAs. And as we mentioned, it all comes down like everything else in real estate to location, location, location. So things could be happening in the Frederick or the Columbia area that are going to be different than what's happening in La Plata or Spotsylvania. So these are some of the things that we wanted to just reiterate that you need to be looking at if you're going to be investing in any of these submarkets. Unemployment trending in the correct direction. Population is increasing. Age, right? Age is going to be there as well. Jobs need to be increasing. Employers are moving into the area. This is going to have a supply and demand dynamic that is very attractive to multifamily investing as a whole. And the reason why I like multifamily is because immediately you can force the appreciation of an asset when it comes to commercial real estate, which is different from single family homes, right? If I can increase the net operating income of an asset, immediately I increase the value. I don't have to wait 6 months, 12 months. Immediately upon increasing the net operating income, I increase the value of the property. Now, of course, I'm not going to sell it immediately, but there are different opportunities that are available to you when you have an asset that is growing its NOI, especially when you're looking from a net portfolio perspective and the conversations that you can have with different banks, et cetera, because you are in control of an asset that's growing in value. That just makes a whole lot of sense and speaks tremendous value to what it is that you're able to do. So I hope that makes sense to you. All right, let's move on to the next slide. Here you have an Excel spreadsheet, right? And that Excel spreadsheet is what we use in order to be able to determine where do we want to invest. And what we do is we give them different numbers, right? So as you can see, there was Greensboro, North Carolina, Raleigh, North Carolina, Richmond, Virginia, and we were giving them scores, and these scores are going to be tabulated based off of these columns over here that come over here to add up the score that's over here. And this is what we're looking for, right? As you very well know, there are 4 cycles to investing, right? You have hyper supply, you have expansion, you have recession, and you have recovery, right? You're looking at whether or not, from a travel perspective, are there easy access points to get in? You don't really want to work where, in order to get to a major hub, you have to take a flight. I love Dulles, I love Reagan International, etc., because those are the places that I would want to only live because I need one flight to get to Chicago or need one flight to get to New York. I don't have to get two flights there. But what you're going to use with an Excel spreadsheet like this, and I believe that we have this available on our private Facebook group, so that as you are selecting your different criteria for your different submarkets, you can determine how you want to go about it. And then you have a scoring rubric that you could actually use in order to be able to determine the submarket that you're interested in investing in. That just makes a whole lot of sense to me. And after we did this the first time, we do this biannually. We do this biannually to determine whether or not if what we saw at the beginning of the year is what we're seeing at the middle of the year. And sometimes you have to change up where you are looking to invest just because the market conditions have changed the same at the same time. So nothing is static when it comes to multifamily investing. And this is what we use in order to be able to determine where we want to invest at the same time. I hope that makes sense to you. So What is going to be your acquisition criteria? The reason why I am sharing this slide with you is because this is a conversation that you must have with your commercial broker, as well as it's going to be a conversation that you will have with your property manager. There are certain property managers that will only invest or work with you on Class A assets. Class A assets are the brand new ones, right? So they're looking to deal with a higher end clientele who could actually afford those rents. Because I can tell you from personal experience that it's very different when you're running, it's very different when you're running a Class A asset versus when you're running a Class C asset. I have personal experience in both of them, and I can tell you, they managing those assets are night and day in difference. So this is what you're going to share. Multifamily residential apartments. You typically want to talk about the number of doors that you're looking for. In this particular criteria, we're looking for 100 units plus, but you could have a ceiling, right? Because managing an apartment complex that has 100 doors is different than managing a complex that has 400 doors. Right now, from my personal experience, I would probably not want to go greater than 300 units, maybe even 250. Between 100 and 250 units is where our sweet spot is going to be, because when you get larger than that, you need a larger property management staff on site, just because managing 400 units takes a different type of team than what you need for um, for managing 100 units. What we like is to have pitched roofs versus flat roofs, right? Because you have a lot more longevity on a pitched roof than you have on a flat roof. What we have seen from personal experience is that flat roofs have require more maintenance. We are also looking for a minimum occupancy of 80%, with the exception of properties that require renovation, provided properties are in well located and present value enhancement opportunities. One of the things that you have to be concerned about is the type of debt that you're going to put on the asset. And occupancy is going to be a factor that goes into the capital stack that you're going to be able to present for the opportunity, right? You cannot go for agency debt if your occupancies are too low. So these are different things that you want to consider. So let's wrap that property criteria into target value, size and price. You're looking for 100 units plus, right, in the range of $5 million to $15 million, right? As you're underwriting it, you're looking for an 8 to 12% cash on cash return, minimum debt service coverage ratio of 1.25. This is going to be critical when you're going to financing, because they're going to tell you what their minimums are. So your property is going to have those types of returns. And as I was mentioning at the beginning of the call, is this is where you're struggling to find opportunities that can maintain a debt service coverage ratio of 1.25 when you're having to put new debt on a property, even if it's interest only. Now, there are two different class mechanisms that you have to think about when it comes to multifamily. You have where the property is located, right? So the property can be in a Class A, Class B, Class C, or Class D location, right? And one of the things that I would also prescribe to you is that you are not able to change the demographics of a location. If it's a bad location, it's going to need more. It's going to need more than you doing a renovation in order to be able to get people to want to come in there and live in that area, right? You're going to need participation from local government officials. You're going to need cooperation from the police force, right? So you can't change an area, but you can definitely change a property. So for value add, my criteria is C minus to B plus properties. I like to have properties that are a little bit aged, have some deferred maintenance. My team will come in and get that property up to snuff so that we can increase the rents. We also like locations, emerging market areas with indicators of strong near and long-term economic growth. You've already done that when you were selecting your MSA and your submarkets, right? You already know that the market area has the indicators that you're looking for your investment criteria, because guess what? At the end of the day, you're always going to have to sell this to your investors, right? And if you don't have an investor list or you don't know where your investor criteria is, I believe that you're barking up a bad tree at that point in time. You need to know what your investors, what kind of returns they're looking for, so that you'll be able to go and shop for opportunities where once you present it to them, they're going to be happy to come along with you for that investment. But that's also a topic for another day and another conversation around capital raising at the same time. All right, moving on. As I mentioned to you, you have neighborhoods and properties, right? Here you have different criteria: Class A, new construction; Class D, over 30 years old, no amenity package, low occupancy, needs major work. I would stress that, you probably don't want to use as an investment a Class D area, especially if you are new to investing in real estate. That's probably going to have too much hair on it in order for you to want to invest there. Class C, built within the last 30 years, shows age and some deferred maintenance. I like those types of properties. I started out in the real estate game doing flips. When I think about Class B and Class C, those are the same type of properties that I was flipping when I was in the single family game. It's just now I'm doing it at scale. So instead of flipping one home, I'm flipping 100 units, right? So I have economies of scale, which makes my investments more attractive. Class A, that's for the big boys. That's where they basically demolish an entire block. They build up a new asset. Developers don't manage properties. So once they get it to the point where you can put some new debt on top of it, they're ready to go sell it and go develop something new. That's the property. These are the things that you can change when it comes to a property. We're probably going to be playing in the Class A to Class C space. When it comes to neighborhoods, right? Class Ds, there's not much that you're going to be in a position to do. Class D, high crime, very bad neighborhoods. As I mentioned, you're going to need a lot of intervention besides you coming in and making something pretty in order to have that turn. But Class Cs, you can work with those because those are going to be people who need affordable housing, but they're not typically looking for all of the amenities of a gym and a pool. What they're looking for is a stable place to live for them and their families that is, within inside of their income range. And as we go up, we start dealing with um, different demographic profiles. I'm not saying that one is better than the other, but you have more disposable income and you could offer more amenities at the same time. My apologies. It seems like I'm catching a summer cold, so the halls is trying to work with me. All right, let's move it forward. Analyzing a deal. How are you going to find an off-market deal? You have a relationship with a commercial broker or two, and they're going to be sharing off-market deals with you. Off-market deals do not show up on Loop.net. They do not show up on Crexy. Off-market deals are truly that. Off-market deals because your commercial broker is writing, communicating, having conversations with multifamily owners, and they're providing values of opinions, and they're asking those people, is now the time to sell for you? Remember, also, another motivation when it comes to multifamily is that the debt. If your debt is expiring, you're going to have to do something. So that's why I like off-market deals. You want to conservatively underwrite the deal. You don't want to talk that you're going to be able to get a 30% IRR right? You want to underwrite it as conservatively as possible because as you get into the project, there are a number of things that can go wrong. You start off with an LOI, but the LOI then moves to something called a PSA. And the purchase agreement or purchase and sell agreement is where it becomes binding, it becomes real. That's where your money actually becomes hard when you move into the PSA stage, right? In order to get the deal done after you have moved into the PSA, you need to raise the capital for the deal, right? Because the deals do not happen without access to resources, right? So you need to bring in your down payment plus your working capital, and the rest of the deal is going to be financed. If you're going to use bridge type of debt or if you're going to use agency type of debt, all of that needs to be taken into account, as well as how are you going to perform asset management. As I say all the time, getting the deal is probably the easiest part of the whole entire ecosystem. Managing that deal through to fruition, that's the hard part. That's where I see a lot of people lose their way. So make sure that you consider how you're going to manage the asset because it's like a marriage. You're going to be tied to that deal for the next 5 years, and you need to know how all of it is going to work. So we have we have shared a lot of information with you today. A lot of it comes from our friend Joe Fairless and his awesome book that he created. That book is a constant reference for what it is that I'm doing today. I don't pull it up as much as I used to, but it's one of the Bibles that I have on my nightstand in my bookshelf because it has taught me a lot about investing in multifamily as a whole. So what we're going to do now is we're going to open it up to any types of questions that you may have on the information that we shared today. So, Avery, do you have any questions?
How is declining population in a particular uh, submarket? How does that impact the deal?
Well, remember, one of the things that I mentioned is that you need increase in rental demand in order to increase your NOI. So if you have a population that is decreasing, that means that there's going to be less buyers for your product, right? So if population is decreasing and there's less demand for your product, you're not going to be able to raise rents, which leads to the value of the property either being stagnant or going down.
Okay, I got you.
But that's a great question. Any other? All right, I'll take that as a no. Oh, do you have any question? Okay.
Actually, I do have another one. In a situation where you're looking at a deal and you do have some level of government involvement um, in an area that would be, I don't know if it would be considered Class D or C or how it will work, but if there is a level of government involvement, county involvement with the redevelopment commission and all of that, are those factors that would positively affect an area that would be Class D, Class C?
Well, I don't think that it's going to be either a negative or a positive. I would have to say you would have to understand the specifics of the area. Like in Texas, there's something called the PFC, where you can have a public-private partnership with the county if you're going to stabilize your asset and provide affordable housing, right? But a lot of guys who are working in urban environments or urban areas, they're also able to provide low income housing tax credits, right? And with that, they are able to get access to some very low cost debt that would make a deal that wouldn't otherwise pencil because of the low debt that is coming onto the property, right? So I would say it depends, and that's the consultant answer, right? It depends on the particular deal, but all of that has to go into your pro forma as you are underwriting the property so that you can determine whether or not if the deal still makes sense.
Okay. Yeah, I get that. That makes sense.
Those, all right, great. So O says, does the same rules apply for 2, 3, and 4 multifamilies? Typically, under 5 units is not considered commercial, right? So if you have a quadplex and you wanted to put debt on a quadplex, you can still qualify for that using an FHA or a VA loan, right? So you can actually go and say that I'm going to buy a quadplex and I'm going to live in 1 unit, and you can rent out the other 3, right? So when you have that quadplex, if there are other quadplexes in the area that have similar square footage, yes, you're probably going to trade against that number at the same time, right? But also, you might be able to value that property off of its net operating income, right? If you don't have comps in your area that are speaking highly and that are speaking favorable to the asset. So you have a couple of different ways that you can go when it comes to stuff that qualifies for residential financing. Oh, does that make sense? But yeah, one of the things that I tell many of the individuals that if they're starting out in this game, if I was starting out all over again today, I would go and purchase a quadplex because I would live in 1 unit. You can qualify with just 3% down if you get an FHA or a VA loan, right? I would live in that because when you think about your income circle, housing is most likely going to be your largest expense. And by you living in one of the units and renting out the other 3, those 3 units should cover your debt service, which means that you get to live rent free. And by living rent free, you should be able to take those resources and you can save it and eventually invest in other deals. I would even say that once you have met the residency requirements for your loan, typically for residential FHA, you got to live there for 2 years, 1 or 2 years. You can rent out the unit that you're living in, maybe do a refinance, pull out some of the equity, and then you can go and buy more real estate at the same time, right? So there's different ways that you can do a number of different things when it comes to these opportunities, right? But yeah, one of the things that I've often heard when it comes to real estate is you buy real estate and wait, you don't wait to buy real estate. So you got to get in wherever you can. Right now, interest rates are over 7%, right? But you might be able to find different opportunities that are available to you. All right, so I think that we have what we needed for our question and answer. I want to apologize again for having the incorrect meetup link out there, but I wanted to let you guys know that uh, here's my calendar, and if this is a QR code, if you scan this QR code, You have access to all of my details and how to contact me. This is my Calendly link, so that if you wanted to schedule some time on the calendar, you can, or you can text Meetup to 571-444-8474, and we'll get back to you about scheduling time with us at the same time. It's just going to be an email that comes out with all of this information on how to get back in touch with us. But I hope that the information that we shared with you today was of value. And, since we're not compensated in any way by sponsors, et cetera, my only ask is that you give us 5 stars on meetup.com, because we're trying to grow the group. We're just north of 500, but, we have ambitions and goals of wanting to get this thing to be over 1,000 different people. So, I know you're no longer in the Virginia area, but our next in-person meetup is going to be on 9/12 at 6 p.m. Eastern. We do a meetup where that meetup is more focused on our residential community, fix and flippers, hard money lending, B burst strategies, etc. We also have an in-person networking event on September 9th at 3 p.m. We host that one at Rich Top Coffee and Tea. And at the end of September, we'll have the last session of the series, where we finalize our discussion on multifamily investing. That'll be part 3. And if you haven't seen part 1, you can go to our YouTube channel and catch up there. And eventually we'll put this presentation up there as well. So, are there any additional questions? If there are no additional questions, I'm gonna, give you back time so that you can enjoy the rest of your Saturday afternoon with family and friends.